What is the stock exchange and how does it work? The stock exchange is nothing more than a giant, globally networked and organized marketplace where every day huge sums of money are moved back and forth. In total, over 60 trillion euros a year are traded, more than the value of all goods and services of the entire world economy. However, it's not apples or second-hand toothbrushes that are traded on this marketplace, but predominantly securities. Securities are rights to assets mostly in the form of shares. A share stands for a share in a company. But why are shares traded at all? Well, first and foremost, the value of a share relates to the company behind it. If you think of the value of the company in terms of a pizza, the bigger the overall size of the pizza, the bigger every piece is. If, for example, Facebook is able to greatly increase its profits with a new business model, the size of the company's pizza will also increase, and as a result, so will the value of its shares. This is of course great for the shareholders. A share which perhaps used to be worth 38 euros could now be worth a whole 50 euros. When it's sold, this represents a profit of 12 euros per share. But what does Facebook gain from this? The company can raise funds by selling the shares and invest or expand its business. Facebook, for example, has earned $16 billion from its listing on the stock exchange. The trading of shares, though, is frequently a game of chance. No one can say which company will perform well and which will not. If a company has a good reputation, investors will back it. A company with a poor reputation or poor performance will have difficulty selling its shares. Unlike a normal market in which goods can be touched and taken home, on the stock exchange only virtual goods are available. They appear in the form of share prices and tables on monitors. Such share prices can rise or fall within seconds. Shareholders therefore have to act quickly in order not to miss an opportunity. Even a simple rumor can result in the demand for a share falling fast, regardless of the real value of the company. Of course, the opposite is also possible. If a particularly large number of people buy weak shares because they see, for example, great potential behind an idea, their value will rise as a result. In particular, young companies can benefit from this. Even though their sales might be falling, they can generate cash by placing their shares. In the best-case scenario, this will result in their idea being turned into reality. In the worst-case scenario, this will result in a speculative bubble with nothing more than hot air. And, as in the case with bubbles, at some point they will burst. The value of Germany's biggest 30 companies is summarized in what's known as the DAX share index. The DAX curve shows how well or poorly these major companies, and thereby the economy as a whole, are performing at the present time. Stock exchanges in other countries also have their own indices, and all of these markets together create a globally networked marketplace.
Do you know how to buy gold? How about investing in a foreign market or follow an index like the Dow? If you don't, you're not alone. Buying commodities, investing in markets, and following an index has been almost impossible due to high costs, strict laws, and other restrictions. Bummer, right? Enter exchange-traded funds, better known as ETFs. ETFs are designed to follow the price of a specific basket of assets and are traded on the US stock exchanges. You would buy ETFs exactly as you would stocks by entering the symbol and quantity. Just like stocks, you can even use different order types to buy and sell them. ETFs are basically an easy and cheap way to gain exposure into a sector that would have otherwise been extremely difficult. Here's Jane. Jane wants to invest in gold. She can do this a few ways. She could buy a brick of gold or a gold coin or maybe melt down her jewelry, but these ways are difficult and time-consuming. Or Jane could buy shares of a gold ETF like GLD, which follows the market price of gold. She can do this for a fraction of the price and with much less effort. Let's say Jane now wants to buy an index like the Dow Jones because she thinks the entire general market will go up. Jane could buy all 30 companies that make up the Dow Jones index for around $11,000, or Jane could buy shares in an ETF that follows the Dow like DIA for around $110. Here Jane is exposed to the same index, but paid 1/100th of the price and avoided the headache of buying 30 different stocks. As you can see, ETFs provide simple investment opportunities that would have been otherwise very difficult.
This explains what a stock is, what a CFD is, and how they are related. A stock is a share of ownership in a company. By purchasing a stock, you become a shareholder in that company. You may benefit from dividends, can vote on key corporate decisions, and possess certain rights. To buy 100 stocks in company ABC at $10, you need $1,000. Purchase equals ownership. The price of a stock goes up and down depending on many factors. You purchase the stock at a quoted price, and the rise or decline in the stock's value results in either a profit or a loss. It's considered a traditional way to trade financial markets. So what about a CFD? A CFD, contract for difference, is a contract between you, the investor, and a CFD provider. It's an agreement to settle in cash the difference between an opening price and a closing price of a particular asset that you have taken a position on. The CFD then tracks that asset price. That's the direct relationship between them. You take the position based on whether you think the asset will go up or down in value. So, for example, you can place a CFD trade on a stock and the value of the CFD position will rise or fall with that stock price. The stock is therefore known as the underlying asset. And as you are purchasing a CFD from a provider, you don't own that underlying stock. Not owning the stock leads to some key differences. For example, CFDs are traded on margin. You only have to put up collateral. This means you can leverage your capital. The amount of margin required varies and is defined by your provider. If it's 5%, typical for large companies like Apple, then that is equivalent to 20 times leverage. Buying the ABC stocks in the example at the start of this CFD explainer was $1,000. If you bought them with a CFD at 5% margin, you would require $50 in your account. Your profit or loss would move with the ABC stock price in the same way as if you owned it. Therefore, the low CFD margin requirement means any profit percentage is higher, but any downward movement is also magnified. And trading stocks mean you have to purchase them before you can sell, meaning that you can profit from a rising price only after you've bought the stock. If the stock drops below your purchase price, you lose out. If you believe that the general market trend is downwards, CFDs are going to be beneficial to your strategy. But CFD trading means that you can sell stocks that you don't own. Remember, it's still a contract between you and the CFD provider, not ownership. Therefore, CFDs allow you to benefit from a falling market. You can sell a CFD on a stock that you believe will fall in price and then aim to buy it back later for less money and make a profit. But remember, if it rises in value, you'll potentially lose money. And stock trading is one asset type or class. A CFD, on the other hand, is an instrument or derivative. Therefore, CFDs can be used to deal on stocks, foreign exchange, commodities, etc. And therefore, more international markets open up to you as an investor, allowing for portfolio diversification, all from one CFD account.